How much money should I invest to profit from FX? Well, new traders often ask that question at the beginning of their trading journey. A few dollars will be enough to start trading in a cent account, but you will need at least 100 to just think of becoming a professional trader and earn a substantial income in FX market. So trading with $100 is a way to train yourself, but that deposit won't be enough to earn big money. Still, it will suffice to gain a basic trading experience in a real account, learn to control emotions, and understand if trading is your cup of tea. So now let's begin with some major facts. A $100 deposit is a sufficient initial capital to open an FX trade in a real Forex account without breaking risk management rules. On average, traders with medium-level experience can earn over 10% of the deposit per month. Professional traders' earnings can exceed 500% a year. So when you trade FX with $100, it's recommended to open trades of no more than 0.01 to 0.05 lots, so that risks should not exceed 5% of the deposit account. So to trade FX with $100, you will need the maximum leverage to lower the margin amount blocked by the broker. So try to open trades in a demo account before you found a real FX trading account. Demo accounts help to work out the optimum trading system. Traders' primary tools are indicators, levels, patterns, an economic calendar, a financial calendar, news feeds, screeners, trading materials, and the broker's analytics. A one-point cost, margin, and volume calculators will help as well. So, can you trade Forex with $100? So, the volume of a position to open in Forex is calculated in lots. For example, in currency trading, one round lot is 10,000 units of a base currency. The minimum lot for the GBP USD currency pair is 0.01, meaning you can buy 1/100th of a standard lot, which equals to £1,000. So, buying £1,000 will cost $1,280. Thus, we can conclude that small trading capital will suffice to open a trade and make money. The solution that your broker offers is leverage. So, for example, with 1 to 1,000 leverage, a trader has a sum 1,000 times more. So a deposit of $100 will turn into $100,000. And so, to open a minimum trade of 0.01 lots, you will need a $1,280, which is slightly more than 1.2% of the deposit and complies with the risk management rules. So the contract and the minimum lot size are indicated in the specification of trading assets. You can find that information on the broker's trading platform by clicking the Trade menu on the left dashboard. You will have the list of available assets in the Info on the Instrument submenu. So let's look at the specification of the Microsoft stocks. So we see that the contract size is 1 share. The minimum trade size is 1 lot. And 1 share's price is, at the moment it was, $344.05. So the margin of 2% corresponds to 1.50 leverage on MT4. So to buy 1 share, we need $6.88 because of the equation that we have 1 share costs $344.05. We times it by 0.02. So with such margin requirements, a trader almost fits into an acceptable risk range. You can calculate the minimum margin for other assets using specifications. So MetaTrader 4 and 5 also provide information on assets. Click on the Market Watch in the upper View menu on the Tools dashboard, right-click a symbol and select Specification on the drop-down list. So step number 1. Let's explore the trading platform with a demo account. And so, a demo account is a copy of a real trading account with the same functions and options. The only difference is that you trade with virtual money credited by a broker and make virtual profits and losses. And so, the advantages of demo accounts are as follows. So the market participants do not risk losing money in a demo account. After losing trades, you can open a new demo account and continue to practice trading. You can top up a demo account in a few clicks at any moment. And so also demo accounts provide technical tools to test various strategies and consolidate trading success. You can also assess a Forex broker's trading advantages, opportunities, functionality, and unique products. And so it's recommended to set a demo deposit equal to the amount you plan to pay into a real trading account. If you want to trade FX with $100, you better not train with a demo deposit of $100,000. So these deposits require different risk management approaches. Responsibility, potential earnings, and losses vary as well. So when you start trading a demo account with $100, you recreate basically real market conditions in which you will find yourself slightly later. So also traders tend to make hasty decisions and open riskier trades when they don't risk losing their personal funds. So this attitude migrates to a real account and can result in substantial losses. So proper risk management is the first thing to learn in demo accounts. Then you also may ask, why use demo account? Well, firstly, to fully understand the trading platform's functionality, have yourself introduced to the trading and trading opportunities. And if you're an experienced trader, but for example, you see Litefinance's site for the first time, explore the options of the web platform and test unique authors indicators. If you're a beginner trader and want to only trade FX with $100, a demo account will help you first figure out trading specifics without putting money into an account. So, to develop experience and intuition and improve decision-making skills. The more you practice trading in a demo account, the more confident you are about your potential and the likelier you will succeed in a real account. And then, of course, next reason is to test strategies. Backtesting evaluates the efficiency of a strategy, its resilience to force measure, and its earning potential. You can use the embedded MT4 tester or, for example, other Forex simulator FX Blue testers to check your manual or algorithmic Forex trading strategy. And so a demo account at Litefinance can be opened without registration or verification. You can pay any virtual sum into your demo account on the web platform, open trades, and explore on the social trading service and the traders' ratings. And so to have your trading history saved, you will need to go through a quick registration, taking no more than 2 minutes. So to do FX trading in the real trading account, you will have to verify your personal information after registration, which many brokers demand, of course. So step number 2, research the market. So the success of a trading CFDs will depend on the correctness of your forecast. At first sight, charts move chaotically, but in fact the market follows certain regularities. For example, news releases. If a company's financial reports show increased net profits, traders start buying stocks and the higher demand pushes the price up. Or most traders decide not to take a risk and close the trades on a certain level. It's when herd psychology starts working and FX market participants tend to close the trades on a strong resistance level. And so a trader's task is to identify proper signals and predict price behavior using existing analysis methods. And so let's talk about Forex market analysis types. Firstly, we have technical analysis. It searches for regularities in the past, presuming they can reoccur in the future. Technical indicators are based on mathematical formulas and statistical algorithms. Next type we have graphical analysis. So those studies patterns like candlestick formations that help forecast future currency market movements. They include trend lines and support and resistance levels. Next, we have fundamental analysis and macro-microeconomic statistics analysis. They include rate changes, inflation stats, employment levels, payment balance, corporate financial reports, etc. Next point is psychological analysis that suggests many traders and their behaviors follows standard patterns. They try catching the last train, start panic selling, etc. The market sentiment indicators help interpret traders' behavior, for example. So then we have wave analysis, which implies that the market develops in cycles in the long term, going through phases. A trader's task is to determine in which phase the FX market is. Elliott waves are an example of wave analysis. So now let's discuss the main information sources. First, we have basic and user technical analytical indicators. Then we have news feeds and metric aggregators, analytical resources with statistical information, traders forums as well, expert investment blogs, economic calendars, financial calendars, educational and analytical channels, brokers, training materials, and the like. So first, let's discuss the fundamental analysis. So this type of analysis studies financial markets based on economic and financial data and political factors that can affect assets prices. So how to make a profit from fundamental analysis in the foreign exchange market? Well, the main idea is to determine what fundamental factors will affect the price the most. A trade is opened in the direction of a price movement. Another way is to place pending orders at quite a big distance before a news release is published to exclude the impact of volatility. And so, fundamental analysis tools are, for example, economic calendar, which contains information on the most important economic events worldwide and indicates their influence and when they occur. Next are financial reports, which are analysis of a profit or losses, balance sheet, and money flows. Any other information on the company as well, their mergers, new business directions, the global expansions, legal cases, etc. Next we have macroeconomic data, which are GDP, inflation numbers, and employment rates. Then we need to talk about news. So these are, for example, central bank statements, regulators' actions, legislative changes, support of economic sectors, etc. Next are reports and analytical reviews. So those are, for example, research and reviews of the best, FX brokers, investment funds, and analytical agencies. Next one are geopolitical factors. For example, the impact of OPEC decisions, trade wars like the one between China and US, and sanctions, a very recent topic, on oil prices. So next we have news trading, which is regarded as highly risky as news releases provoke very volatile spikes. Okay guys, this video turned out to be a little too long than I expected, so I will cut it in two parts. So basically now is the end of part 1, and I strongly encourage you to wait for the update of part 2, where we will continue the journey with this topic.